Our next guest has about as diverse a portfolio as you'll ever find, with major investments in energy, real estate, tech, travel, media, and, of course, sports. Todd Boehly is the co-founder, chairman, and CEO of Eldridge Industries. Joins us in a live CNBC exclusive interview. It's good to see you.
Thank you very much.
So I mentioned this diverse portfolio you have. We're talking more than 70 companies. So given all of those areas, you have a really good look into a number of different spots in this economy. How do things look to you?
Things feel better than you would have expected based on all the chit-chat over the last 6 to 12 months. I think you see hotels are performing well. People really like experiences. Businesses generally are hanging in there. I think there's been obviously a little bit of inflation in the cost of goods, so we've seen margin compression. But generally, we feel really good about how the businesses are performing.
I mean, what's your outlook for where rates may go from here? What you think the Fed is going to do, whether there's going to be a recession or not?
Listen, I think we've seen the back end of the curve move up pretty dramatically lately, and we think that's been a very helpful thing for the Fed to not have to continue to move. Obviously, when the front end was at 5 and the back end was at 3.5, I think that was really a bigger challenge. But now you've seen the back end move up pretty dramatically, and that's really started to put the brakes on some things we believe.
In other words, the market's already done the Fed's work for it.
Yes. Yes.
Do you think they're going to be finished?
Listen, I think they're going to be data dependent, right? So, my bet is that they're done for the year. If I had to bet right now, but I believe that they're going to be data dependent. And I think if you look at the prognosticators of where rates are headed, most people believe that in 2024 rates will start getting cut again. But again, I think this comes down to what happens. And the good news is that rates have risen enough where we've got room to wiggle. So, I think we can see our way out of a problem if a problem arises.
Interesting. You said almost a year ago at a conference that, quote, the cost of money is being repriced. You just have to adjust and accept that money is just going to cost more now. Well, it's obviously costing more now than it was even a year ago, but is that impacting the way and the size, the kind of deals you're looking to do?
It's absolutely driving us to credit. We're spending a lot more time in credit. We've done quite a few loans in the last couple of months where we're getting 12, 13, 14% rates of return by being kind of $1 at the top of a capital structure in structures that are, let's call it 4 or 5 times levered, where, before, we were 6, 7, 8 times levered, and you were making a lot less money. So now we think it's a really good time to be a lender. But of course, there's no prepayment penalties on loans. So the reality is, once rates start going down, we're going to be refinanced out of that. So the challenge with credit is that you're always on a treadmill trying to figure out what's next, because the really good ones don't stick around very long.
Talked about credit. Howard Marks's new letter literally just dropped an hour or so ago, arguing for a reallocation of capital towards exactly what you're talking about, credit. Quote, credit instruments should probably represent a substantial portion of portfolios, perhaps the majority. Says you can get equity-like returns now in credit. Of course, you started the credit business at Guggenheim. You know this segment of asset better than most.
Now's a good time. And I think if you look at where within the credit markets you want to play, senior secured lending has always been a really good asset class. It goes up and it goes down, but generally for me, it's a great asset class year in and year out. High yield bonds, I think a little more fickle, right? When you're looking at high yield bonds that are 100 basis points, 200 basis points behind senior credit, I'm not sure why you'd want to be buying those. But when they're 400, 500, 600 basis points more spread than senior secured loans, then I think high yield bonds are a really good thing to be buying.
Yeah, this does play as well into sort of your strategy of what you're trying to do at Eldridge, get bigger in asset management focused on credit.
Yeah, we're in the process of consolidating a bunch of asset managers. We had a very good success with something called CBAM that we built from scratch and then sold it to another alternative asset manager. So rather than sell these businesses to alternative asset managers, we want to grow them and we want to scale them and get the benefit of having multiple businesses working on the same end game.